Hey bosses, we are back with, just 1 second. Show Me the Money, the segment in my channel where we talk about investment in real estate and more. And today we're going to talk about how the interest rates affect your multifamily market price. Hey guys, my name is Jevaux and I'm a real estate investor, developer, agent, and not for the purpose of this segment, but I'm also a yacht broker. So if you're looking for a yacht, you know who to talk to. And today we're going to talk about how the interest rates affect your multifamily market value. I already did a video explaining very deeply what is a multifamily property, but just to recap, a multifamily is a building, a structure that has 2 or more doors. 2, 3, 4, 5, 10, 100. And they are separated in 2 categories, residential and commercial. Residential is here in Florida, anything up to 4 doors. 5 doors or more is considered commercial. And why that's important? Because the commercial properties are valued differently from the residential. While the residential are valued for a fair market price based on the sales of comparable properties, the commercial multifamily properties are valued based on how much money they make. So let's say you invest $1 million in a property and it returns to you net $100,000. And I'm just doing round numbers to make it easy. $100,000 out of 1 million is 10%. That's your cap rate, the capitalization rate. How much your money, your investment is being capitalized every single year. $100,000 over $1 million, that's 10%. And that's how a market price of a multifamily is settled. So the interest rates affect that because once the interest rates go up, investors want more return for their riskier investments. Why? Because interest rates mean how much the government is, in this case, the Federal Reserve is paying for people that are buying their bonds, the 10 years, usually the 10 years treasury bonds. And the reason that the Fed raises and lower the interest rates is to control the inflation. Inflation is basically how much the dollar worth, and is the job of the Federal Reserve and central banks all over the world to control the valuation or the devaluation of their own currency. So when the government wants to stimulate the economy, the government tells everybody, you, me, and everybody in the economy saying, look, I want you to spend money. So in order to do that, if you save your money, if you put your money in a bank account, in a savings account, I'm not going to pay you anything for it. So you're going to lose money basically, and you're going to see that money there and you are not going to have any benefit. So when the government said after COVID, bringing from 2.5% interest rates to 0.25 interest rates, the government was telling you, look, I need you to spend money. I want you to spend money. So government gave you that incentive saying, if you save money, I'm not going to give you anything for it, or I'm going to give you very low. If you save $100 this year, I'm going to give you 25 cents after 1 year if we still have that bond. The problem with that is when everybody start doing it, there's too much money in the market, and everything in the economy, money included, when there's too much of it, their value go down. In case of money, it's easy to see that because we see prices of services and goods going up. Real estate went up, cars went up, everything went up. Food, entertainment, everything went up. Why? Because people are spending more because they have more available money. Either they are making more money or either they are taking money from the bank, a loan, for example, because the interest rates are super low. So when the general prices of the economy started to go up, the government said, you know what? I need those prices to come down a little bit. I need those prices to stop going up a little bit. So I'm going to incentivize Daniel, you that is watching, and everybody else to save money instead of investing or spending that money. How do I do that? I say to them, look, I am the safest person in this room. There's nobody that can guarantee you a return the way I do it. So right now, instead of paying you 1/4 of a point every single year, I'm going to pay you 2% in your money. So you say, you know what? I'm making 4% on my multifamily, but now that the government is giving me 2% for basically just holding my money, and I know that the government's not going to be a problem for me in the future, I think I want more for my multifamily. Instead of 2, I want 4. So in our example that I said before, I told you that with $1 million, we could make $100,000 and the cap rate would be 10%. So let's say that now, and I'm just playing with numbers here to make an easy math for everybody. Let's say now the government says that the interest rates are too low, the inflation is too high, and they say, you know what? I'm going to raise the interest rates from 0 to 10%. And then you suddenly see, well, if my multifamily pays me 10% and I have risk there because I have maintenance, I have tenants that can come in and out, I have a bunch of problems to deal with, I have the city permits and blah, blah, blah. Well, 10% is not going to be worth it because I can make the same kind of money lending my money to someone that I know it's going to pay me and I have to do absolutely nothing. So now to buy a multifamily, I want 20% return. So Mr. Investor goes there, knock your door and say, you know what? I want to buy your multifamily. I see it's making $100,000 per year. So now I want, and you're going to grab your calculator and you're going to make $100,000 and you are going to divide for how much do you want per year? 0.2%, which is 20%. So right now, your multifamily is worth, or the multifamily what you want to buy is $500,000. Why? Because if you invest $500,000 and you receive the same amount of money, the $100,000 per year, that represents 20% of your investment. So that's why when the government plays with the interest rates, the market value of assets, that their value are based on a return, a rate of return also fluctuates, also can go up and also can go down. So if the Fed continues to raise the interest rates of the economy, investors to invest their money in more riskier assets such as multifamily properties, and I'm saying is riskier comparing to the government bond. Of course, a multifamily is not riskier compared to cryptocurrency or the stock market. Inside of that comparison that we are doing, multifamily and interest rates, of course, multifamilies are more risky. Therefore, investors want more money out of it. So when the interest rates go up, the government, the safest investment in the world, says, I'm paying more, you want more to compensate the risk that you have. If the government lower this, of course, you're going to say, you know what? Now I don't need that much return because, well, the government's not paying me anything anyway. So I'm just going to invest more and receive less. So that's why you need to keep an eye open to your multifamily market price, because interest rates are going up and that will affect, number one, the purchase power of investor, because usually people buy it leverage, and with a higher interest rate, it's going to be more difficult to make the numbers work out. And also because in a market value situation, the premium right now, the risk premium is higher, leveraging the potential of reducing the market value of that multifamily. So there you go. If you want to buy a multifamily, now is a good time to start negotiating. And also, if you own a multifamily, now is a good time to start selling it, because the interest rates are still low. It's 0.5%. Before COVID, it was 2.5%. So there's a lot of things to still going on there. And yeah, just make the best of it. And I hope you learned something today. Bye-bye.